I wanted to follow up on NIO, and I'll show you guys my actual trade log here. And I got to do a shout out. We have a coaching client named Hank, pretty cool dude. And Hank turned me on to NIO. He actually has been long in NIO, so he's been looking for a way to recover from that investment. But the scoop is he turned me on, and this is a classic income generating symbol. And just NIO is the electric car company from China. Their technology seems solid. Their business plan seems solid. But as with most stocks coming from China, especially with some of this macro news of Xi Jinping taking over for a long-term play as prime minister, and some of the stuff that's going on there, it's been hitting China stocks across the board, and NIO is not at all missing that. So here's the play, and I just wanted to feature it because this is what I did. So I didn't want to actually buy NIO stock. And so back in June, when we first started featuring NIO, instead of buying the oh my gosh, my magic marker got all swollen. Let me get rid of that. I bought some NIO call options instead, and you'll notice that these NIO call options, they expire out in March of 2023. So they're far out in time, and they're pretty deep in the money. And I bought about 25 grand, just under 25 grand, 24 grand of these NIO call options, right? And then about 2 weeks later, on June 27th, and that was when NIO, so I bought it, let's see, June 14th, bought it right around here. So on this little dip that NIO was making. And then about 2 weeks later, NIO had spiked a little bit. And I said, well, this is a perfect time to take some income and set up some protection. So that's exactly what I did. So it took about 2 weeks, but on June 27th, I set up those income trades. I sold the NIO call options, and I bought some protection with some put options. And sure enough, I sold the July 15th options. When July 15th rolled around, those options expired worthless. So I got to keep all that income, $1.81 per share, or about $3,606. And then a few days later, actually more like 2 weeks later, I decided it was time to, I didn't need that insurance, that put protection anymore. And so I sold those back pretty much at a break even. You can see that it cost me $2,434 to insure this position. And when all was said and done, I sold those insurance options back for $2,466, kind of a break even trade there. So I got to keep all of that income, and I was protected the whole time, and it didn't cost me any money to protect that. And then I was still left with those call options. So what does a good premium seller do? They wait for the good opportunity. It took about another 16 days. In other words, I'm doing managing of this trade about every 2 weeks, about twice a month. So on August 16th, I did the same thing again. On August 16th, I made another $4,486. I used some of that money, about $2,174, to protect it. But this time, fast forward to September 7th. On September 7th, I went ahead and sold that insurance back for $2,786. So this time, not only did I insure the trade during that period between August 16th and September 7th, but I also was able to sell the insurance back. So what I'm doing here is basically, and it's kind of neat, I'm buying insurance like you would buy insurance on your car, and I'm deciding how much of a deductible I need to have. In some cases, I might decide to pay more for the insurance up front and then have a low deductible. And in other cases, I might decide to have less insurance cost up front, but have a higher deductible. And that kind of explains the strike price that I'm choosing, as well as how much did I pay. But here's the difference between like an auto insurance policy and what I'm doing with the insurance with the options is that when I'm done and I don't need the car insurance anymore, there's actually a market to sell it back. And I'm selling it back either for how much I paid for it, or I'm selling it back for a slight profit. Now, you can't do that with auto insurance, but you can sure do it in the options market. And that's where my strategy shines. So I did that all over again. And then I did it a third time on September 16th. And here's what happened. Let's take a look. And this is another neat thing about the way I teach this SIP is on September 16th, which was around here, was the perfect time for me to go ahead and buy some of that insurance, sell some of that premium. And then look what happened to NIO, right? NIO started to break out down. In fact, I had this beautiful channel described about how I thought NIO was trading in a sideways channel. And it got to the point where it was about 40% below the channel. And that gave me a hint that, hey, NIO is no longer in that channel where I can make monthly income off of it by just doing a couple trades a month. Instead, NIO is trending down. And that's what's so cool about my position. My position auto adjusted, meaning I didn't have to do anything to it. What happened is those NIO calls got stopped out. And they did get stopped out. If you look, I paid $12 for them. They got stopped out at $9.45. And you might say, oh man, you took a beating on that. But I had those protective puts in place. In fact, I had those protective puts in place from September 16th all the way up until Wednesday. So that protective put took advantage of this whole downturn. And because I got stopped out, they weren't protective puts anymore. They were actually puts. In other words, this trade auto adjusted from an income trade to now a trade that took advantage of this downturn. Those puts that I bought for $1.18 a piece, I wound up selling them back at $4.82. So when all was said and done, even though NIO took a bath in the last month and a half, and you would think that would decimate me as an investor, I walked away with 40% ROI, 39.9% ROI on the initial amount I invested. I invested $24,114 and I walked away with $9,626 of profit.